If you're a new property investor, someone who's only invested in the last couple of years or hasn't invested yet into the Australian property market, you're pretty scared right now. You're fearful about the prospect of interest rates potentially going up. In this video, we'll be talking about what more experienced property investors, how they look at the world, and I'll be sharing with you two key charts so that even though you're inexperienced right now, you can put those fears to rest and really be educated through a more analytical approach to understanding interest rate movements and property markets. If you're interested, carry on watching. My name's PK and I help people build passive income through the Property Investment Accelerator using data without needing a buyer's agent, $15,000 every single time. All right. So guys, in this channel, we talk about how you can get ahead through property investing. If you're new, please smash that subscribe button and give it a thumbs up. That's really good for me. Hopefully it's good for you as well. So this is the first chart, the RBA cash rate timeline. You can see that all the way from September 2011, interest rates have been going down. This is RBA data. Now, one thing I'll mention here is actually in 2011, the consensus amongst all economists was that interest rates would go up for various reasons. Back then, the European countries were really going through a lot of recessionary period. I won't go into it, but they didn't go up. They ended up going down. So the first lesson is just because the consensus of economists is for rapid rate rises, that doesn't always happen. History has proven that it doesn't always happen. But I'm not going to say that's not going to happen this time. I'm just saying it is not a guaranteed fact. The second thing I want to illustrate to you through this chart is that the last property boom that Australia experienced before this one really started around 2015, right? And it was led by Sydney and then Melbourne. It started around 2015 and it ended around 2016-17. All right, so this is this period here. In this period, interest rates went down by maybe 0.5%. So the interest rates weren't really a huge catalyst, you could say, to the main reason why property markets increased. That's one way of looking at things. The second thing I want to say in terms of that is that Melbourne and Sydney started falling in value in the middle or towards the end of 2017. All right, so that's kind of around here. Interest rates didn't go up at that time. So clearly there are other market forces at play in Australia other than just interest rates, right? There has to be, otherwise interest rates is flat here and Melbourne, Sydney started falling by quite significant margins. You can 5-10%, something like that. So demand and supply is what ultimately rules, property prices in Australia. Interest rates are one equation of that. The third thing I want to mention on this chart is that even though Sydney, Melbourne started declining around this period, all the way from end 17, all the way to kind of mid 19, this period here, actually, if you invested in other areas across Australia, like Geelong in 2017, like Ballarat in 2017, places in Brisbane in 2017, dozens of suburbs, dozens of locations across 2017, you would have made hundreds of thousands of dollars, not just because of the current property boom, but because of 2017, because of 2018, because of 2019. The same period in which Sydney, Melbourne were falling. For example, if you had bought in Geelong in 2017, you could have bought a house, within 2-3 kilometers or maybe 5 kilometers of Geelong Central, Nor Lane, other places like that, for under $400,000-$500,000. And by the time 2019 came around, those same houses were worth $500,000-$600,000. Okay, so $100,000-$200,000 of gain, about 25% gain in 2 or 3 years. That's pretty good. All right. So the point being that there are markets within markets. Just because Sydney, Melbourne fall doesn't mean that everywhere falls. Just because the national headlines by Channel 7, Channel 9, News.com, SMH, AFR say that property prices are tumbling, that doesn't mean that everywhere is tumbling. The best time to invest was back here. The second best was here. Third best was here. Fourth best here, etc., etc. In other words, the best time to invest is now because there are markets within markets. The whole property market is not one market. There are 15,000 suburbs. Right now, in the next 2-3 years, many will fall in value, e.g. unaffordable areas of Sydney, and many will continue rising, e.g. many parts of Brisbane, regional Queensland, regional Victoria, regional New South Wales, Perth, Adelaide, etc. Okay, and the fourth point I want to make here is that yes, we're at very little low interest rates, and the only way from here is up, really. So even if we get the worst case scenario of, let's say, 2, maybe 3, some people are saying 4, even though the RBA has categorically said it won't happen, 4 interest rate rises this year, you're sort of going back to normal times, right? You're going back to what it was in 2019, mid to end 2019. And by the way, for those of you who don't know, the current price cycle of Sydney and Melbourne, the inclines, the appreciation, the capital growth didn't start because of COVID. It actually started all the way in 2019. If you had bought in Mount Druitt in 2019, by the start of COVID, in the beginning of 2020, you would have already made $100,000. All right, so I just want you to understand like more of an analytical approach. Guys, if you're getting value, I have many more things to share with you in this video, like savings rates and one more chart. Hit subscribe, give it a thumbs up, stick with me. Now, the worst case scenario over the next 2-3 years maybe is that interest rates go up by, let's say, 2%, right? Maybe 2.5% for all of you bears out there. That takes us from 0.1% all the way up to, let's say, 2.5% here, back into December 2014. Now, yes, that makes things less affordable, but just remember, that's actually when the last property boom started. So people were piling into property at this point, and Sydney almost doubled in value in the preceding 5 years. So you have to understand things with context. Yes, things are becoming more unaffordable, but everyone who has been a property investor for 5, 10, 15, 20 years time knows that the best time to invest is now, so long as 2 things are met, 2 criteria. One is you know where to buy, because there's markets within markets, some declining at any time and some inclining or appreciating at any one time. And the second thing is you know how to buy. Where to buy is just one part of the equation. How to buy, how to actually execute, buy interstate, anywhere, be a borderless investor from Sydney, from Melbourne, buy anywhere across Australia without needing buyer's agents. That's the second thing. If you know those 2 things, or you can learn those 2 things, it's always a good time to buy, because there's no point putting your retirement fund, your passive income, your aspiration to leave the 9 to 5 on hold. That doesn't make any sense. If you're 35 years old right now and you're putting it on hold for the next 2 years just because interest rates are rising, you're just going backwards, because you're still going to die at the same time. You're still going to retire or want to retire at the same time. Why put your finances on hold? The second chart I want to share with you is this one right here. So what I want to talk to you about here is Australian households are storming ahead on their mortgage payments by almost 4 years thanks to a surge in savings during the pandemic. So I know what you're thinking. You're like, all right, PK, the last chart, I understand your 5 points, but interest rates are rising. That thing means that mortgage repayments are going to increase. There's going to be foreclosures, right? There's going to be defaults, right? That's what everyone's thinking. There's going to be fire sales, more stock on market, prices are going to come down. I understand that why you're thinking that way. But what this is saying is that homeowners have taken to making a dash on their loans by utilizing pandemic savings, with a record 50 billion funneled into offset accounts. Okay? The really interesting thing to note here is that the Australian noted the average households were 45 months, okay, 45 months, that's not 45 weeks, in other words, a year, that's 45 months, more than 2, 3, 4 years, ahead of principal and interest payments, and 52 months ahead on interest-only mortgage repayments. So 52 is bigger than 45. That means investors, who majority go interest-only, investors are actually more safe, less likely to default than anyone else. And even owner-occupiers, they're so far ahead in their repayments that even if interest rates go up 1%, 2%, let's be crazy and say 3%, won't happen in the next couple of years, but let's just be crazy and say that, they're fine. And the reason? Household savings ratios. So since 1959, right now we have the highest amount of savings. That's because we couldn't travel. We buried that money under our mattresses at home. We have it languishing in the savings account, and the offset account's doing not much at all. you're right, saving very little interest or accruing very little interest. So that's the reason that you have to understand both sides of the balance sheet. The expenses, which is in the profit loss statement of a household budget, it's an expense in the household budget, but also your assets, right? If interest rates go up 1%, 2%, 3%, won't happen, but let's just say that. What's going to happen? You have to increase your mortgage repayments. People have enough money to do that. They don't need to sell. If they don't need to sell, then they don't need to sell the house, right? They don't need to sell it. If they don't need to sell it, then supply stays the same, demand stays the same, prices don't fall. So when's the best time to buy property? Right now. Okay? And I hope I don't come across as a spruiker. I mean, these are facts, these are just statistics, and hopefully you can be educated and not put your own financial future on pause just because your family, friends, colleagues, mainstream media, which has created more anxiety and more lack of achievement of people's financial potential than anyone else in the world. The mainstream media, put that to the side, understand analytics, follow this stuff. Don't just listen to me blindly, understand the numbers and make money now, not in 6 months, in 12 months, but right now. Guys, hopefully that was useful. If it was, hit subscribe, give it a thumbs up, give it a like, and join my Facebook group. More than 12,000 people, links below, having these discussions. So you can see that no, I'm not just a kind of weird person out trying to spruik something. There are seasoned investors who know that this is the right time to buy. All right, 12,000 of them. And also my podcast. You can really understand these things if you're on the go. And I think just the last thing I'll say before everyone heads away is you might be thinking, well, let's just write it out. Let's just wait 3 months, 6 months, see what comes of it. But places like Adelaide or Brisbane in 6 months' time are going to be 10% more expensive. Perth is going to be maybe 5-7% more expensive in the next 6 to 8 months. So it just doesn't make sense. Like, the money is there to be made, right? Just go make it. Just be wary, markets within markets. Sydney, Melbourne, probably not so much. If you're in Sydney, Melbourne, invest elsewhere. Not financial advice, but just me giving you some of my thoughts. Catch you later, guys.